Good afternoon, everyone. So the markets are down again, and we're approximately 20% down from the all-time highs. But is this technically a recession? Are we in a recession? Are we heading to a recession? Or have we already been in a recession? I'm going to answer those questions next. My name is Paul Shelton Jr., and I am the Chief Investment Officer of Warwick Shore Advisors. We are a wealth management firm based in Orlando, Florida, with clients all across the United States. If you have any questions about your wealth, your retirement, please reach out to us directly. We'll be more than happy to work with you. So the big question of the day is, are we in a recession or are we headed into a recession? The possibilities of that are much higher today than they were a year ago. Potentially, I think investors and most analysts are projecting that we have about a 60% chance as of right now of seeing a recession over the next year. So let's go ahead and define technically what a recession is. We all know what it feels like to be in a recession. We know what it feels like when our incomes are lower, when our paychecks are lower, when we see massive layoffs. But technically, a recession is defined by having 2 consecutive quarters of negative GDP. So the question is, and the answer could be arise from, will we see 2 consecutive quarters of negative GDP within the United States? And so that will take place at the end of this quarter, where we are right now in the first quarter, as well as the second quarter going into the summer months. So will we have negative GDP in both of those quarters that will allow us to classify our economy as being in a recession? And then the answer that I have for that is based upon fundamental data and based upon the research that we see, we will not be in a recession that soon, coming up at the end of the second quarter of this year. So although our research shows us that we will more than likely not be in a recession when we come into the summer of 2020, we do have several things that will be a catalyst to lead us potentially into a recession. One of those things is the coronavirus. So by now, everyone is familiar with the coronavirus and how the coronavirus, or the spread of the virus, has affected the markets overall. We've seen a precipitous drop in the markets since about the end of January, when the virus was first exposed to the mass public, to the global theater. As a result, we've seen a significant amount, an extreme amount of volatility in the markets. And that volatility is always surrounding the uncertainty about what will happen or what the economic impact of the virus is. As of now, we have a situation where there is a shortage or a lack of supply and demand as a result of the virus. So you have suppliers that are shutting down factories that are unable to produce as much supply, and then the demand aspects are not there as well. So in an attempt to spur the economy and try to lessen some of the blow from the coronavirus, the Federal Reserve has reduced interest rates, and they did an off-cycle reduction of interest rates by 50 basis points, which is major. This throws a huge signal to the economy and to investors that, hey, we see something down the road potentially that we are unsure about. There's some uncertainty that the Federal Reserve has forecasted or is forecasting or seeing in their forecast that they do not have an immediate answer for. So one of the tools that the Federal Reserve uses is their manipulation of interest rates. And I know manipulation doesn't sound like a good word, but they manage interest rates in order to speed up the economy when it's in a period of slowness or sluggishness, and to slow down the economy when it's moving too fast or when you're getting into a point of overinflation. So the signal of reducing interest rates is a sign that our economy is reaching a point where we forecast potential sluggishness down the road. It may not be present yet, but they're forecasting that there will be a significant hit to our gross domestic product from the effects of the coronavirus. As a result of those reduced interest rates, we've seen interest rates across the curve, as I mentioned, that would potentially happen before. All those interest rates have fallen. We have never been in a point where we are right now in the U.S. market where we have the whole interest rate curve. All maturities are under 1%. We've never been in a point like that before. The rest of the globe right now has negative interest rates when you think about all the other domestic economies around the world. It's very possible that we could see that in the U.S. Do I want to see that? No, I don't want to see negative interest rates in the U.S., but we are inching closer and closer to that possibility. So where we currently are in our economy with interest rates being so low is really in a dangerous place. If the economy does fall into a recession, whether it's at the end of this year or the beginning of 2021, the Federal Reserve will have a lesser amount of weapons to combat that recession with the most recent interest rate cut. So the biggest question that we will have to answer, and no one has a crystal ball and will be able to forecast this, but we will have to see how strong our economy is, how strong and resilient this economy will be once the coronavirus is no longer mentioned like the Zika virus back in 2016. We all of a sudden have forgotten all about that, but it was a major hysteria at the time, just like the swine flu. So we've seen things like this happen several times in our economy, but there could be a difference this time based upon where the health and the overall financial health and strength of our economy is. So we're hoping that once this headline news moves past us, and once there's a vaccination, and once the spread of the virus starts to decrease, that the economy will prevail and stand strong on its own two legs. However, this is the perfect time to start setting your plan, set your financial plan, reassess your asset allocation, and make sure that your asset allocation is meeting the goals that you have set up for your retirement plan and for your money. If you have any questions, please reach out to us at investments@warwickshore.com. Look forward to hearing from you.